We will have also delightful discussion with our guest speakers. Uh, and he is already here. Okay. So, good morning, Mr. Somea. Can you hear us?
Yes, I can hear you. I can hear you. Thank you very much.
Yeah.
Yeah.
Okay.
Sorry,
Thank you
sorry.
very much. Yeah.
My camera
I,
is not very good.
yeah.
Okay, go
Okay.
ahead.
Yeah, that's good. I beg your permission. I will be your moderator today.
Mhm.
So yeah. First of all, uh, let me share to all of you the curriculum today for Mr. Somea. Yeah. Um, so guys, Mr. Somea is a prominent associate professor from a graduate school of international department from Nagoya University, Japan. He also have many international experience from OECD and Minister of Finance in Japan, and so on. Also here we have already know he has many research that has been published. Uh, well, I don't think we need to uh, list all of them. Uh, However, we will, uh, of course, have one or two discussion related to this. So, uh, okay. And today we will have until like 10:45 discussion. It will be also include our question and answer. And today meeting will is series from before, so we don't need any opening remark. Maybe some of you has already attend another meeting before, so this is the continuation. All right. Our topic today is about the global financial and banking condition and what to expect. So, essentially, we will have discussion about what is in it related to our recent global financial economic and how to respond it and how econom see about it. All right. I guess I don't need to extend my explanation since our prominent speaker is already here. Mr. Somea, I give the floor to you.
Okay. Well, thank you very much for your introduction. Let me share the screen. Let me. Okay. Okay. Um, all right. I prepared today four topics, but I don't think we can accommodate four of them, all of them, into 90 minutes. So right now it's actually five past, or let me check. All right, five past 9. So I'm going to talk about perhaps very introductory part of financial sector, and maybe if we have time, we move on to financial crisis in industrial countries as well as in developing countries. Okay, let me start. All right. Okay. So let me start with the crowdfunding. Many people um, uh, right now, many people are concerned with financial inclusions. Um, Many people thought it's not easy to have access to financial market and the financial instrument if you have low income. Then, um, but right now, access to financial market and the use of financial instrument have been very much expanded for last 10, 20 years. I'm going to give you one example for crowdfunding, and then perhaps move on to something, I mean, kind of a brief introduction of financial sector. Okay, crowdfunding. Crowdfunding is a term that refers to open calls to public to raise fund for a specific project. These calls are often published and promoted through the internet and the social media. The fund are typically small contributions donated by large members of contributor to private companies that is not listed on the stock exchange. So it's private actually. There's no promise that the original investment of a contributor will be returned at any particular date in time. Right? This is the volume of crowdfunding in 2017. North America, Canada, United States outstanding. But Asia, we are also second in the 6 regions. Actually, much more than Europe, which is actually because of China. Crowdfunding is very, very popular in China. And then this is how crowdfunding, have been funding. As you can see, majority of crowdfunding comes through peer-to-peer lending. Peer-to-peer lending is actually, I live in Japan, donate or lend $10 to someone who has a good business model in Indonesia, or maybe someone in Indonesia fund to someone else in Indonesia. This is called peer-to-peer lending through internet. And then second one, which is also traditional funding. It's actually reward and donations. Donation is one of the funding instrument for a long time. And the reward. All right. So if let's say reward is something like okay, you have a good business model. Let's say to produce maybe what else? What is it? Perhaps car, but you don't have money. So, but you have a skills and then you have a factory, but you don't have a money to buy something. I mean, iron or rubber to build to manufacture a car. So let's say if you donate me $100, when I sell, I'm gonna manufacture a car, and then I sell this car, and then I get the sales proceed, and then part of proceed, maybe $10, $10, I give it as a reward or as a return. So you contribute monetary, you make a monetary contribution, financial contribution, and then you get the reward. This is a reward and donation-based crowdfunding. And then another one is particularly this is equity crowdfunding. Equity is a stock and a share. So let's say you make a $100 contribution, and then you get one equity, one share. And then, when you are in a private, this is one stock maybe value only $100. But when the company go into initial public offering, then listed at the stock market, then the value, if the business model is good, then the value of your stock is going to soar up, maybe $1,000, something like that. So, but as you can see, peer-to-peer lending is very, very popular. In terms of size, because this is, from person to person, so that's why actually the amount of the contribution is very small. Sometimes $100, sometimes $1,000 in compared with reward and donation-based crowdfunding, which could be 1 billion. And equity crowdfunding is also can be a 1 trillion, 1 billion, 1 million. But this is because this is for ordinary persons, peer-to-peer funding, the each lending is very, very small. But remember, this is call on the internet. So even though maybe one person contribute $1, but if you have 1 million people who can donate or who can contribute, then it's going to be $1 is going to be 1 million. So this is quite popular funding style in last 20 years. Okay, how does crowdfunding work? Crowdfunding was originally donation basis. Well, it's traditionally it was only. This is a unique style. A person or business wishing to finance a project would request donation to help fund the project. Uh, Donors frequently receive the reward related to the project based on the amount donated. For example, artists or musicians. This is actually a very, very popular and famous examples. Musicians have used crowdfunding to finance the printing of their novels or production of their CDs, rewarding donors with signed copy of their book or free CDs. Um, the Marillion British rock band reportedly emailed 6,000 fans requesting they purchase their album CDs in advance. Ultimately, they used crowdfunding to finance their tour 30 years ago. This happened in 30 years ago. Since then, crowdfunding has been growing very fast. All right, equity crowdfunding in the United States. Crowdfunding is become very popular because of its success in the United States. U.S. had a kind of regulatory limit for funding. That's called 500 shareholder limit. The 500 shareholder limit threshold was a rule mandated by SEC, stock exchange committees, that required companies to publicly disclose financial statement and other information, financial information, if they have 500 or more distinct shareholders. So whenever the country have shareholder more than 500, they have to show or they have to meet the kind of information requirement criterions. Yeah. So that is actually it's a kind of burden because you have to pay a fee to professional accounting companies firms to audit and then disclose it. It's actually lots of work. So that's why many private companies, which are not listed in the stock market, prefer to stay as a private because in order to avoid this additional work burden. The rule in place from 64 to 2012 was meant to discourage fraud opacity. So actually, this rule was not meant to hinder small investors, but actually to protect the market and the shareholders. Legislation providing an exemption for small crowded investment was passed by the U.S. House of Representatives in November 2011. And then the famous Jobs Act was passed in 2012 and made direct mention of equity crowdfunding, introducing legislation that allowed for a wider pool of smaller investors with fewer investment restrictions. So So there's no limit in terms of number of shareholder. So company can receive many small investors. One person investing maybe $1, but 20 million investors, something like that, without any additional cost of disclosure of financial informations. So this is a start of the crowdfunding in United States, and then quickly spread into the other countries. So let me start with Adam Smith's word before moving on to introduction of financial sector. Humans have a propensity for track, trade, barter, and finance. So um, Mr. Smith knows that finance is intrinsic to human being. All right. Let me talk about financial market. Financial market involve market participants who forge contract under some rules that are either monitored and enforced by participants themselves or by regulators. Financial market is consistent from borrower, lender, and regulation, and liquidity providers. Maybe everybody knows. And then there are 5 factors in financial market. Managing risk. When you invest, which means actually you may lose your money. So you have to manage risk. And also, if the banks or companies, you deposit your money or you put your the money for investment, if banks, companies funded by the investors if they go into bankruptcy, so many people lose, as well as this problem is going to spread to the small corner of the economy, and then becoming a full-fledged financial crisis. So financial managing risk is crucial when you have a financial market. Transferring resources, which is a financial intermediary. I have a money, but I don't have a business skills. But you have a money, you don't have money, but you have a business skills. Then, okay, again, you can use my money. Then this person make a lot of profit, and then give me a dividend or returns. This is kind of give and take. So transferring financial resource from one person to another is going to contribute to the economic growth. Pooling resources. I have $1, but $1 cannot help anybody. But I deposit $1 in the bank, and then so does others. Maybe 1 million people deposit $1. It's going to be $1 million, which can be used for project. So pooling resources is one of the functions of financial market. That include capital market, equity market, as well as banking sector. Price discovery. Yeah. The price of equity share can be determined in the market, as well as the price, of the bond, which is actually other side of interest rate. So interest rate also can be discovered in the bond market. And the clearing, settling, payment. This is crucial functions of the financial market and also banking sector. So you pay, and then I receive, which is actually cleared and settled by the banking sector. You don't have to meet. You don't have to meet in person, but you just put the money on your account, and then bank is going to allocate, transfer your money from your account to my account. So clearing and settlement played a crucial role in the economic transactions, financial transactions. So these are the important functions. And then player 4, borrower, lender, regulator, and liquidity provider are the 4 players. Okay. By the way, you know borrowers, someone who borrows. You know lenders, someone who lend. You know the regulators, someone who regulate the market, the government, you know. But who is liquidity providers? We will find out later on. Right? Borrowers. It's easy, right? This is a wish list of borrowers. Borrower wants lower funding cost. I mean, borrowing costs. Borrower want infrequent interest payment because if every day you have to pay interest payment, then every day you have to have a cash surplus, yeah, which is not easy to meet. Instead of once per year you make an interest payment. In that case, only one day you need to have a cash surplus. Full control over use of the borrowed fund. Okay, no one tells how to use your money which you borrow, which is very unlikely. Well, it's unlikely in banking sector, but likely in financial market. No monitoring. You don't want someone who is watching over you in every step you take, right? The long maturity, which means you borrow $1 million and then tomorrow you have to repay, then no use. But you borrow $1 million today and then you pay maybe 100 years later, then you can, it's very convenient for you, right? And then no collateral, which is this is crucial part for both for borrower and the lenders, as well as financial market development. Collateral. Borrower, particularly if you are small business entrepreneurs, you don't have collaterals. So which means, but you want to borrow, right? So that's why actually no collateral. Unfortunately, the smaller the business entrepreneur, the more collateral required. Well, that means actually if you are the large corporations, then no collateral is required. Usually that's the case in many countries. Toyota, when they borrow from Mitsubishi Bank doesn't require Toyota to put up the collateral. They analyze business model and the lend. But if you are the small shop owner, then banks always requires collateral to put up. Okay, lenders. Here is a lender wish list. Totally opposite to wish list of the borrowers. High return. It means high interest rate. And then frequent payment. Of course, you you have two options. You lend money to and maybe which have a maturity maybe 10 years. You get interest payment only once at the end, or you get interest payment every year. Which one is better for you? Of course, payment every year is better. Full control over borrower's use of borrowed fund, short maturity. Yes, because this is coming from moral hazard. Maybe later on I may mention that means actually once borrower borrowed money from someone, lenders, and then before borrowing, borrower said, "Hey, I'm going to use this money very carefully." But once you got the money, you wanted to take largest advantage of this money, which means actually you are looking for higher return, higher return means higher risk. That's why actually once the borrower got the money, then they tend to use for risky business than they announced before they borrow the money. So this is called moral hazard. Moral is good in terms of how to use the money before borrowing, but moral is bad. In moral of the borrower is bad after they borrow the money. And then also ample high value liquid collateral. Okay, high value liquid collateral. Well, because what if the borrower who borrowed money from the lender go into the bankruptcy, then you need a collateral to collect your money, right? So if you lend money, and then the best way is actually the borrower put up collateral which can cover all the money you lend, right? So this is kind of, quite different, well, opposite to wish list of the borrowers. And then borrower lender, okay. What are the obstacles that prevent these participants from agreeing to contract? So what you need for both of side, borrower and lender, to agree. Lack of sufficient borrower and lenders, that is not enough, or that's not enough lender, which means if there's one lender and 100 borrowers, what happens? Interest goes up. Yeah, and then if there are 100 lenders and one borrower, interest go down. Yeah, so you need both sufficient lenders and borrowers, sufficient numbers of lenders and borrowers, and then okay, when you don't know each other, when you know each other, well, that means friends. The contract or negotiation among friends is easy, yeah? But negotiation among two, borrower and lender, who do not know each other is very difficult. It takes time. Information is perfect asymmetric, that this lender cannot assert in creditworthiness of the creditworthiness of the borrower. Okay, asymmetric means actually, all right, usually borrower knows your business, right? Business is risky or business is solid, and then business make a high return or business make maybe low return. But the lender doesn't know. So that's called informations which borrower has. It's different from information that lender has about business. Yeah. So that makes actually very difficult for both sides to come to the agreement. Rule of law as an obstacle to contracting. That means the existing law may prohibit certain contracts. Well, in Yemen, well, in case of Indonesia, although both are the Muslim countries, but different economic structures. In case of Yemen, taking interest is not is actually prohibited. Most of the banking sector are actually Islamic banks, so they they don't requiring interest payment is not prohibited. So sometimes, but among people or among companies, they borrow each other with interest or something called similar output sharing, something like this. If someone borrower doesn't pay this sharing profit, then it's gonna go to the court trial, right? If the court said, hey, you are taking the interest rate, then this lender will lose the money. Yeah. So sometimes law is kind of different, and then some bad guy take advantage of rule of laws. That makes actually both sides, borrower and lender, to come to the conclusion. I mean, come to agreement. Monitoring and enforcement is costly. That means too expensive for lender to verify borrower's action. If you lend the money to someone, you want to watch over her borrowers all the time, but it's costly. You have to work, right? You have a other business, so you have it's impossible for you to watch over borrowers all the time. So that also makes lender very, very conservative and reluctant to lend. What do we need to alleviate these obstacles? We need good governance and transparency, change in laws, and enforcement of existing ones. The third main participant, for this reason, we need regulators. That's actually without regulations. Let's say, all right, someone borrowed money from the bank and then doesn't pay, but they are not punished. Then no bank lend money. So regulator, well, depends on the country culture as well as the characteristics. They have to have a good law or regulations, legislations, which makes lender feel comfortable to lend. Yeah. Even in Islamic development bank, Islamic banks, there is a rule that actually force both sides, borrower and lender, to meet the rule. Then no problem. But in case of Yemen, law is not well established. That's why actually sometimes you borrow, you don't pay, but get no punished. So this kind of stuff event happens. All right, first, regulator want stable financial market. Of course, regulator is the government. If the government no government wants financial crisis, right? And then regulator wants to develop the financial market. Of course, why? Government is a regulator, and the government benefit from financial market development. Why? Because they issue bond. Bond is a extremely major financial instrument. If many people buy bond price goes up, which means actually government do not have to pay interest rate, high interest rate. Yeah. So which is good for the government. So government wants financial market development. Well, no financial crisis, which is similar to stable financial market, but stable. Perhaps I was confused. Perhaps I should have said stable financial market is there's not many winner and not many losers. That can ameliorate income inequality. Yeah. And also no financial crisis. Financial crisis put everyone into troubles. Yeah, so everyone loses from financial crisis. That's why actually no one wants financial crisis. Yeah. All right, liquidity providers. Who are they? They are professional dealers and traders. Okay, they are called market makers. Attractive financial instruments such, maybe let me, before moving on to the explanations, who are the dealers and traders and their functions? Dealers and traders are intermediate transaction from their customer to the market. Yeah. And then sometimes dealer and trader using their private account, they make their own trade. Investment. So that actually is good, because let's say I want to buy a bond or I want to buy stock of the Toyota, and then I put the order into the market, nobody takes it. What happened? Then, that means nobody takes my order, which means actually when I buy, okay, even I buy the stock, but when I sell, nobody will buy it, right? And then you have to sell in order to make a profit. You buy you buy Toyota stock maybe $100 and keep it. That's also one strategy. But in many participants in the market, they buy they buy the stock at $100 and then they sell stock at 110. So that return $10 is your profit, capital gain, right? So you have to sell when you participate in the market. But what if nobody buy your order? So that makes me feel, hey, I don't wanna. Well, I have to be careful. I shouldn't buy it because nobody buys means I cannot sell when I want to sell. Yeah. So no liquidity means actually you. So that makes actually hinder the market to develop. That's why. Well, if all right, what if I place the order in the market, and the dealer and traders, they are always ready, and then they are already take on the buy and sell every day. Then my order will be processed taken by the dealers or traders. Yeah? And then okay, then which makes investor feel better, secured. Yeah, there's always someone who buy and sell. Then I feel better, so I maybe next tomorrow I also make another investment. In this way, liquidity and the side of the capital market, I mean financial market, grows. Yeah. So we need dealers and traders. And then for I think Indonesia has a primary dealer system. That means actually dealer primary dealer always has to buy and sell when the order are placed in the market. Usually dealer and trader, you don't have to buy. It's your job to make a profit by buying and selling operations. But you don't have to buy and sell if you are private, I mean company dealers. But primary dealer, you have to sell it. But one of the benefits for primary dealer is actually you have a subsidy from the government. Subsidy is not the money, but sometimes you have access to information of the fiscal situation, something like that. So the trader, dealer, in the market take order and then sell and buy. Trader is actually intermediary between the market and customers. All right, sufficient counterparties to transact with, be it borrower, lender, or other traders or dealers. So this means actually many participants. Well, that is the same for everyone. And then low transaction costs. Of course, this professional dealer and traders make a financial investment many times per day. So the cost must be when the cost is lower, people can place more. So that's why actually transaction costs, the lower the better. Maybe you may think when the cost is high, then these guys, dealers, make a profit. Yes, that's one reason. But a major part of their income is coming from actually capital gain, not the transaction fees. Yeah. So yeah, and then the lower the transaction cost, the more participant. So actually, usually the lower the transaction cost, the better. and the fast and secure clearing and settlement process to protect integrity of transactions. Well, you pay, and then perhaps seller, you pay now, you're a buyer, so you buy stock and then sell, pay. But the seller who sell the bond, I mean stock, receive money 3 years later, then nobody wants to sell. Yeah, just usually settlement is T+2, which means 2 days after the set transactions, or T+1, 1 day after the transaction is actually normal. It's popular in among countries. Then, what would be attractive instrument for a dealer and trader? Did I? Well, perhaps I didn't mention financial instrument. Yep. Well, attractive financial instruments such as debt instrument or various maturities. Yeah. All right. If you have only 1 day overnight instrument such as call, overnight repo, then well, or maybe you have a one overnight to 30 years maturity. Of course, if the market offers various maturity, then more people invest, right? So financial market will benefit if they offer diverse financial market, including short selling. Maybe you know the short selling. Um, Okay, people think stock market or bond market, you buy and then you sell. That's the margin between the price you buy and the price you sell is your profit. Yes, but that's not the unique source of your capital gain. Capital gain comes from you sell it and then buy it. Yeah. For example, let me one example. Okay, you believe that financial market, stock market fall. So Toyota right now, one stock is $100, but it's gonna be $60. Yep. So if you have a based upon your analysis, you think Toyota stock will fall, then you talk to insurance companies. Uh, insurance company because of their structure of balance sheet, because the liability is their payment to death, right? So actually, but people keep paying 30 years, 40 years. So liability is actually long term. That's why actually they want to have a asset side also long term. So they buy the stock and then they keep it 20, 30, 40 years. Yeah. In proportion to the average maturity of liability side of their balance sheet. I mean, insurance companies. So they buy Toyota stock and they keep 40 years. They don't sell it. So that's why actually, if you know Toyota stock will fall, then you talk to insurance company. Hey, can I borrow your one Toyota stock, one stock of Toyota? And then at $100, right, which is a ongoing market price, right? And then nobody lends you money, lends stock for free, right? Okay, but I pay you $1 if you lend me one Toyota stock, right? From the insurance company's point of view, they for them actually they keep the stock for 40 years anyway. So they don't sell, they don't do short operations. Yeah. So, but if they lend one Toyota stock to me and then get $1 as a fee, then they are happy. Yeah. Okay, I get the one stock to one Toyota stock, then I sell it. I get the $100 because this is the ongoing current price of the Toyota stock. I get $100, and then I borrowed one stock from the insurance company and sell it at $100. Now I have $100. All right, 6 months later, as I predict, Toyota stock falls $60. Now I have $100, and then buy Toyota stock again at $60. Then 6 months later, I give it the Toyota stock back to insurance company in addition to $1. So, I got $100, and then I paid $61. I have $39. That's called naked short, or sometimes short selling, which was hated by European crisis as well as the Chinese market government. But one of the function for this short selling is actually magnify the liquidity. Yeah. So, that makes actually there is always a seller, or when the seller, market that's this kind of short selling increase market liquidity. Sometimes people think because when we have a financial crisis, these guys short selling is the driving force to put everybody into troubles. But in normal times, it's actually the prayer to increase liquidity. So when you have many instruments, that makes actually that increase liquidity. Okay, what would be the attractive instrument for a dealer or trader? Large size of issuance. Of course, if you have a large size, if the stock is always selling and buying one stock, nobody can buy more than that. That means, and also someone who buy this stock can keep it for a long time. So until they sell, there are no transactions. But if you have maybe 1 million of participants, then for dealing with same stock, then you can buy. It makes investor easy to buy it. As I said, when you buy it, you have to sell it, right? And then your worry is actually, when I sell it, is somebody going to buy? Yeah. But if you know so many people are making investment in this market, then you are pretty sure that when you sell, somebody is going to pick up your order. And sufficient long trading life, which is long maturity or repeated issuance. Okay. So maturity, as I mentioned in a previous slide, it's good to have a diverse maturity, a diverse financial instrument. And then, but long trading life, long maturity is crucial because usually in developing countries, maturity is very, very short. Perhaps I don't know in case of Indonesia, what is the longest maturity of the bond, but usually 5 years in developing countries, 3 to 5 years. While industrial countries, they have 40 years, 50 years. Mexico, I think last year, they issued 100-year centennial bond. Yeah. But there's not much liquidity for demand and supply. Supply is easy because government issued a bond, but there's not much demand for long-term bond in developing countries. Why? The longer the bond, longer the maturity, the more uncertainty. So that's why actually in developing countries, longest maturity is 3 to 5 years. But in case of longest maturity, in terms of maturity from the issuer point of view, viewpoint, all right, let's say government issue bond, and then build a highway system. It takes maybe 10 years to complete. Yeah. After 10 years, you start collecting the tolls, fees of the use of motorway, highway system. Yeah. Well, the bond maturity usually maybe 2 years. In that case, during 10 years, you have to issue and redeem and reissue. This is called rollover. You have to roll over 5 times, right? Each time you have to have auctions and something like that. So when you have a 10-year bond market, then you don't have to roll over. So every time you roll over, you have to worry about, is there enough much liquidity to absorb this issuance? But when you issue a 10-year bond, you don't have to worry about this rollover risk many times. Okay, sufficiently large turnover. Turnover is the transaction per day. Multiple use for the instruments such as government bond. Yeah. Well, this is different from issuance. Issuance is government issue 1 million of bond. Yeah. But 1 million bond, each time every 1 million is bought and sold, then turnover is 1 million per day. But nobody's sell this bond, then turnover is 0. Yeah. Of course, if there is a high turnover, then there's a liquidity. So that makes investor feel better, secure to invest in bond market. Attractive risk profile, ability to isolate and trade one risk, for example, using government paper as a collateral to reduce credit risk of the borrower. Well, risk profile is not just this one, but also if your companies, you have a robust financial structures or a good business model, and then government paper as a collateral is a transaction called repo, repurchase agreement. That's actually all right. You have a 1 million bond. This is particularly popular among interbank market. Yeah. Bank have 1 million bond. Yeah, but this bond is going to be redeemed in 1 week time. But customer comes and then you have to give the cash, yeah, from her account. You need the cash. You can sell this $1 million bond. Then you have a lot of money, and then you pay out $10 to this customer. But it's not actually well profitable, right? If you wait for another 1 week, then 1 million is going to deliver maybe $1,000 or $10,000 as a return coupon. So you don't want to sell this in order to pay just $10 to the customer. So in that case, you place order in the interbank short-term money market. Hey, I have a bond, $1 million bond. So can I borrow you $10? And then if this bank doesn't have any bond, then maybe you are worried. Hey, can this guy pay back? But the bond, he has a bond, she has a bond. So that makes it easy for the banks to lend $10 to this person, this bank, right? So it's called, so actually, government bond plays actually the role of collateral when in the financial transactions. This is called repo. This is also one of the instrument as well as the risk profile. So if you have a bond, then I mean, bond can be a collateral. Then it's good to have a bond always, for to borrow in short term. So that makes actually banks always buy some bond, always keep some bond as a collateral for financial transactions. That makes actually that increase liquidity of the market. Yeah. Okay. All right, market developing policies. Well, that's what time now? We have still okay, 14 minutes. Okay, all right. Okay, there are many market developing policy, but maybe you are not. Maybe it's important, but let me move on to bank and capital market. This may be more interesting for audiences. All right, the financial structure, we have a bank-based structure and market-based system. Is financing through banks better than through capital market, or vice versa? Capital market include actually corporate bond market as well as equity market. Are some financial institutions better suited to the early stage of development than others? Well, I think Indonesia is more like a bank-based system, and so is Japan, and so is Germany. European countries, except for UK, all of them are actually bank-based system. And then UK and the US are more like a market-based system. Yeah. Bank-based system is a banks, in the bank-based system, banks are major lenders. By contrast, in a market-based system, bond and the equity market are the dominant player in lending. Bank-based system, banks can make lending decision based on the relationship, which helps increase credit availability to firms and individuals, and potentially lower collateral requirement when the information is limited. Banks tend to know their customer and the community. Well, this is called relational lending or relationship lending. Okay, as I mentioned, there is asymmetric information between lender and borrowers. Yeah, borrowers knows their business, but lender doesn't know. Yeah. So, in order to come to the agreement in contract for both sides, lender and borrowers, lender need more informations. Yeah. And then about the business model. Bank knows because they always banks have always visit these companies, not always, but maybe periodically or regularly, maybe past. Well, I was once a commercial bank staff, and then I was visiting company every week, same company every week. So I know, hey, this company is very, very cleaned every day. Yeah. Or this company is always having troubles in accident. Which firm you want to lend, you know it, right? So based upon the relationship with banks, bank has accumulated lots of information about the companies. And also bank has a bank account. I mean, bank has a bank account of the companies. And then you can take a look at the history of financial transactions. Is this company, or has this company always paying on time? Or is this company always paying late? Is this company paying utility, just a small bill, $20, $30, electricity or water? Yeah. Is this company paying, if the company is not paying utility on time, that means actually there are problem in terms of cash, right? So of course, you don't want to lend. Yeah. But this relationship, this relationship helps bank to, helps bank lend when in the contracts. Yeah. If there's uncertainty, huge uncertainty, banks require collateral. Yeah. But if you have a data information about company, then banks require lower collateral, which is not the case of financial market. Yeah. All right. Banks acquire information about firms and can induce better corporate governance. Well, all right. Uh, Maybe the same as Indonesia. When you borrow from the bank for risky business, well, bank wants to monitor how the money is used, right? That's why actually, okay, bank said, okay, I lend you $1 million, but you have to accept one person from the bank always on your board, management board, yeah, so that this person from the bank can watch over how $1 million is used. And then bank system offer better risk sharing over time, better than market, thereby avoid short-termism of equity market. All right. Banks has skills for risk management, but but market offer risk management instrument, but they don't do risk management for you, right? So and then yeah, and then banks knows well, banks is actually the risk management is one of the bank's role in this economy, because asset side and liability of the banking sector, banks, asset side is actually loans, which is actually 3 to 5 years. But on the liability side, which is the deposit, you have to pay when you have a claim from the depositor, right? So actually, that's actually liability side. Depositors, okay, depositor is actually on demand. So today, I deposit, this afternoon, I cash in. So maturity of the liability side of the banks is very, very short, while that's in asset side is long. So bankers' contribution to the economy is the management of short-term liability and long-term asset. So the banks, the service of the bank is actually management of the liability in short asset side and the liability side. So this is actually risk sharing system, yeah? Risk management system. Bank has a risk management skills. Okay, capital market. Market are better at encouraging innovative, high growth projects compared to banks, which tend to have a bias toward prudence against high risk project. Okay, why? Of course, banking sector have more information about the business, yeah? But they are reluctant to make a risky investment. Why? Okay, investor, they invest out of their money. So lender lend money out of their pocket. Yeah. But what about banks? Banks lend out of what? Out of deposit. Yeah. Deposit. People deposit the money at the bank because they believe they can cash in anytime when it's necessary. Yeah. That could be a saving for retirement life. Yeah. So if the banks go into bankruptcy, this going to cause lots of huge loss in many innocent people. Yeah. So that's why actually bank has to be a conservative in terms of risk taking. So that means actually bank cannot lend risky asset. As you know, as you guys knows, startup always is risky. But startups are necessary for the economy, because without startups, economy will not upgrade their industrial structures. Okay? When you are low income countries, maybe majority of the economy, economic structure is based upon the labor intensive industries such as clothing or garment, or maybe processing, yeah, and maybe agriculture based. But when you are, but value added of the agriculture is very, very low, and the value added of garment industries or clothing industry is very low. So if we want to, which means actually your income is low. So if you want a higher income, you have to have a higher value added industries like automobiles or IT, right? Then if your economy is dominated by the 100% dominated by agriculture, there's no way to upgrade your industrial structures, right? So you have to have and then you have to have a startup companies, which is very small at the beginning, but goes up a huge giant like Microsoft or Google. When they started, they are very, very small. Yeah. But without financing, they cannot grow, right? So that's why actually, all right, if the risky finance is banks are risk, banks dominate lending market 100%. There's no way to for startup to grow. Yeah, bank always require the collateral, and they are risky. They are conservative in terms of lending. But capital market, people invest out of their pocket, so they can take risks. And then which happened in United States, Microsoft, Google, when they are small companies and maybe private, which means actually they are not listed in the stock market. Some angels, venture capital, found their business very, very lucrative, profitable. So private as a private equity participations, they lend money and then they give money and then buy stock in private, right? Then Microsoft got money and then expanded the business like now. So if the banks are dominating the lending, capital market, lending market, then economy doesn't upgrade their industrial structure, then economic growth is very, very small. Okay, market can help put pressure to replace inefficient and incompetent managers, especially when the bank's incentive to exercise corporate control are distorted, prevent outsiders from replacing the incompetent managers. This is the case of for family-owned companies. I guess in Indonesia too, there are lots of family-owned companies, right? When they are listed in the stock market, then stock market goes down. Then stockholder requests to change managers. Stock market conference, market holder conference. Okay, banks does sometimes. Banks which lend money to these family-owned companies, when the business is not doing very well, they are not doing very well in terms of business, then banks can request the manager to change. But that's not frequent. But in case of stockholder, they every year they request the managers, because their one of their motive to hold equity is actually dividend, annual dividend. When your dividend is low, then of course they request the manager to change. Yeah. So market replace managers every time. Always. So that company become more productive, efficient, and then business grows. market can be more effective gatherers or processors of information in new uncertain situation involving innovative product and processing like yeah, I mentioned short selling. Okay, all right. Right. Banks, they are, as I said, banks are very risk not conservative in terms of taking risk averter. Yeah. While investment stock investors are more like risk takers. So that's why actually, if for the small startup companies, you can make a more, you can borrow more from the capital market than banks. Market can also help reduce problem in opaqueness and concentration of the industries ownership faced by the bank-based system. Well, yeah. So actually, banks and the market are complementary each other. Okay, bank versus market. Bank and the capital market can complement each other. For example, bank can raise capital in the equity market or tap funding in short-term funding market. Well, bank are the dominant player in short-term capital market. So bank benefit from market. And also, as you know, most of the bank take the money from wholesale market, which is actually corporate bond market. Yeah. So banks issue corporate bond, then get the money and lend it to private businesses. In developing countries, because income is low, but expense, food price is the same everywhere in the world. So that's why actually saving is very small, which means actually deposit, the size of deposit is very small. Yeah. But for corporate bond, you can issue bond in London. So there's no constraint, domestic, a small side of saving constraint. There's no constraint for in terms of small saving. Yeah. And the equity market also allow exit strategies for venture capitalists by listing company in the stock market, known as initial public offerings. Well, that's actually one of the advantage in the market. Yeah. Okay. So venture capitalists is actually always invest in the startups, which have very small access to bank capital, bank lending, and yeah. So, but once you buy their stock in private manner, which means actually they are not company are not listed in the stock market, yeah. And then this company fly to the big market like Microsoft, and then the one stock you buy long time ago is going to be a huge value. Each segment of the financial system overcomes market frictions in different ways. For instance, public capital market have advantage in high information environment and do not need to close relationship among parties. While banks have advantage in relationship-based environment with limited informations. Yeah. In case of big corporations, information is everywhere. So there's no problem in terms of gathering informations. One of the adverse side of disadvantage of the market is actually the investor doesn't have information on the companies, yeah? While banks always have. So in terms of information, about companies, market is inferior than banks. But that's actually for small corporations. Big bank, they have to they are all, I mean, they have to disclose their financial state. So information is everywhere. So for big bank, they, well, access to the stock market is easy. While small, so big corporations, access to stock market is easy. For small corporations, access to stock market is almost closed, nothing. Yeah. So they have no other choice but to ask the banks to lend. On the other hand, some studies suggest for less developed countries, well, developing countries, a banking system is more important because, well, as I said, um, okay, um, for big corporations, they, well, in developing countries, not many big corporations which on which the information is available. So that's why actually banking sector is more, and also uh, one reason why stock market is not very active in developing countries, maybe except for, I guess, Indonesia. Indonesia is now, stock market is huge. Yeah. One of the reasons for inactive stock market in developing countries is actually disclosure of informations and also quality of informations. In case of Jordan, well, um, uh, um, okay, company listed in the stock market have an obligation to disclose their financial information, which is audited. But in case of Jordan, where I used to work, the quality of the information is very bad. So investor cannot believe this information. That's why actually they don't invest in stock market. So that's why actually there's no, so stock market is small and they're not liquid. That's why actually many companies have to ask the banks. Okay, this is a bank and market in terms of credit to the GDP in banks, and then market capitalization, which is actually size of stock market to GDP, right? Some companies, most of the countries are more like a bank dominated, which is blue. But US, Netherlands, well, Thailand is also has a lot of huge market. Okay. All right. Okay. We have 15 minutes. All right, 15 minutes. Okay, so we have been talking about banks and capital market, and then perhaps you are more interested in a financial crisis. Yeah. Okay, let me introduce maybe Japan. In case of Japan, perhaps before moving to financial crisis, Japan financial system has largely been a main bank system in which most companies have a relationship with several banks, but each identifies one main bank with which it maintains a special relationship. So main banking system, it's actually, or let's say Toyota has a main bank, Mitsubishi. So Mitsubishi take, all right, although Toyota borrow from maybe 10 banks, but Mitsubishi is the main bank, which means actually 9 of the banks follow Toyota. I mean, sorry, 9 of the other banks follow Mitsubishi. When Mitsubishi said, "Hey, I'm not gonna lend you," then all the other 9 banks will say, "Hey, we cannot lend you." Yeah. So, it's not. It's easy for Toyota to disclose all the information to one bank rather than disclose the financial, I mean, information to 10 banks. So cost of the disclosure of the information is lower in main bank system. The main bank is the largest company lender. Sometimes it's one of the largest shareholder, and then tend to have a director on the companies abroad. Well, maybe I mentioned banks when they lend money, they sometimes send person to board director who can look over, who monitor the companies. Today, Japanese banking sector mainly consists of several types of banks that serve different types of client. City banks and other large banks, for instance, have a nationwide network and overseas operation that serve large Japanese companies, while regional banks primarily serve domestic client bases. Credit corporation or credit union serve mainly farmers in the agriculture, forestry, fishery, and industries. Right. When I was a undergraduate student, we had 13 city banks, big banks, and then maybe 80, 90, maybe more than two, not more than 200, but many, more than 100 banks. But now we have only 4 city banks, big banks, nationwide banks, and 90 regional banks, and more credit cooperative and credit unions. Okay. Okay, so we have 15 minutes. So let me move on to well, I prepared a lot. Too much, I guess. Yeah, let me take a look at this one. Okay, all right. So far, yes, in case of Indonesia, I think the banks played a pivotal role in financial crisis. But look at this world GDP growth. We had a problem. Okay, we had an Asian crisis around 2000, but their impact is actually just a 2% of GDP, right? Maybe it was 4%, but after Asian financial crisis, it was 2%. So, but look at the Lehman shock. It was 4%. 4% become minus 2%. So minus 6%. It had a huge negative impact on the world economic growth. Lehman shock, right? Financial crisis occurs when the information flows in financial market experience particularly large disruptions, with the result that financial friction increase sharply and financial markets stop functioning. Then economic crisis activity collapse. Yeah. This is what happened in financial crisis. And then first stage of the financial crisis is actually mismanagement. In case of Indonesia, it started with actually huge capital inflows because Indonesian government opened their capital account, which means actually they lifted up all the restrictions on the capital transactions. Yeah. So that's why actually capital inflow flew into Indonesia. One of the motive for capital inflow was actually Indonesia. Well, at that time, Asia was actually rising star in the world, still rising star. And then Indonesia was one of the, not one, but the largest country in ASEAN. Yeah. So that's why actually people think Indonesia is going to grow very fast. So that made foreign investors come to Indonesia. And then deregulations, reform in financial transaction by the Indonesian government helped these situations. Okay, in case of Lehman shock, actually the problem is financial instrument. Yeah. Let me. Okay, increase risk. Okay, then they may not. Hmm. Okay, they use lots of collateral debt obligation (CDOs) or mortgage-backed security (MBS). Yeah, and then so new something new. Sometimes it's coming from financial liberalizations, or sometimes innovative financial products. They are the beginning. Well, it's not the reason, but there uh, is a kind of trigger. If you can manage financial liberalization in proper way, or if you can manage financial instrument in proper manner, then no problem. But this is new stuff for you. So sometimes you mishandle, you know, you mishandle in a small way, but initially, but it's gonna grow in a full-fledged crisis. Okay. Um, Asset price boom always happens before the crisis. Price of assets such as equity share, real estate can be driven by the investor sentiment well above the fundamental economic values. Okay, why asset price, well, booms? Why? Let's say because financial liberalization means you are having lots of money inside in Indonesia, same as in Thailand. Thailand receives lots of money from abroad. So you have a money. You have a money. You have to use it. So, and then in case of Thailand, or which is a typical case in developing countries, well, investors do not trust equity market. And then also the bond market, government bond market is very, very small. So investors have no other place to invest their money, except for real estate. Yeah. So in case of US as well as Thailand, they people invested a lot of money to real estate sectors. Okay. All right. One of the problem of real estate is actually liquidity. Yeah. Why? Because let's say bank give loans to, housing loan, mortgage loan to house owners, right? And then that's actually asset side of the bank balance sheet. What about liability side of the balance sheet of banking sector? Liability is actually small part of the liability is coming from deposit. Most of the liability at that time, same in Indonesia, is actually coming from abroad. So Thai banks, or I don't know Indonesia case, but Thai banks, I know, they borrowed a lot from abroad. They issued a bond in international capital market and then funded. Yeah. And then to be worse, they funded short, means they funded 1 year or maybe 3 months or 6 months or 1 year, not long. Why? Why they borrow? They fund short end of the maturity. Well, because the interest rate is lower, and then also many banks borrowed issued corporate bond in international capital market at floating interest rate, not fixed. Because usually floating is lower than fixed. So Thai banks are funding very cheap, but maturity is very short in foreign currency, right? And then what they invested is actually real estate. As you know, real estate in domestic currency. Well, of course, domestic currency, but one of the problem in real estate is actually liquidity is very, very low. And then I mean, what I mean is actually maturity is wrong. Yeah? Because well, same as maybe other countries, housing loan takes 20 years, 30 years. Yeah. So maturity in asset side is 20, 30 years, but liability in well, maturity in liability side of banking sector is very short, less than 1 year. So it's called maturity mismatches. And then people, well, this is the one reason why I mean, the banking sector collapse in the Thailand. And then also another mismatch is actually in currency. Banking sector was lending the housing loan, extending housing loan, which is in domestic bahts, Thai bahts, but their liability side, their liability is in dollar because they borrowed from abroad. Yeah. So there's a mismatch between in currency. So all right, once something happens, well, before the Thai crisis, Hong Kong stock market crashed. That is going to cool down the investor sentiment. Then, hey, we believe East Asia is doing well. Maybe not good idea to keep the money or long time. So some investors are actually flowing out, which means actually banking, and also this is a liability side in banking sector is short. So actually every 1 month, 2 months, 3 months, money are flowing out. Yeah. So money are flowing out, which means liability side is actually shrinking, and then banking sector in Thailand has to uh, 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 squeeze their um, asset, which means actually, hey, give me back the, you can, banking sector could have said to lender, hey, then return me the money. Then you can pay to, creditors, right? But it actually 20, 30 years maturity. You cannot say, hey, return it to me, right? You have to wait 20 years, 10 years, 30 years, 30 years. And also, when the money are flowing out, the currency had depreciation pressures. For a while, central bank was actually sustaining buying operations of the bahts and selling US dollars. Yeah. But once central bank ran out of the international reserve dollars in their vaults, then they cannot respond to buy bahts by selling dollar because there's no dollar. So at that point, Thai baht depreciated a lot. When the Thai baht depreciated, then it affects actually external debt service burden. Well, when the 1 baht is equal to $1. In order to pay $1, you pay only 1 baht. But let's say baht depreciated 100 bahts per dollar, which means actually in order to pay $1 debt payment, you need to have 100 bahts, right? So that makes actually situation very, very worse. Yeah. So that is what happened in Thailand. But in case of Greece, it a bit different. Okay, Greece was one of the EU members, so they use euro, right? So which means actually for the German bank or Italian bank, there's no exchange risk when they buy Greek bond. Yeah. And then because of risk premium of the Greece high, so that's why actually return from, yield from the Greek bond is much higher than that of German bond and Italian bond. That means actually Italian banks and German banks and Spanish bank, French bank, all were buying a Greek bond. Yeah. And then there's a convergence criterion that says every Euro member country has to have a fiscal deficit less than 3% of GDP. So they know the Greece is actually running deficit, but less than 3%. Yeah, but when the ruling party changed, new party found out previous political party was actually lying, then Greek debt was more than Greek deficit was more than 3% of GDP, or it was actually 12% of GDP. That put Greek bond very cheap. Everybody was selling Greek bond because they know Greek had a problem in fiscal. Then they have a problem. They may have a problem to pay back, to redeem the bond, right? So everybody sold Greek bond, and then Greek bond price goes down. I mean, fall. And then what happened? All right, German bank have a Greek bond, and then when they bought it, value is $100, but now it's $30. So which means actually it's squeezed. It's actually devastated asset side of German banks, as well as the French bank and Italian bank. So banking sector had a problem, then they don't lend money to private sector, and GDP growth rate is slowed down, and then whole countries or region went into the crisis. So financial sector is important in terms of helping growing economy, but it actually they can be a very dangerous actually for triggering a recession or financial crisis. Okay, thank you very much. This is the end of my lecture.
All right, thank you, Mr. Somea, and everyone. I think and I believe that we already have very much perspective on how the works of global financial and banking performance in recent conditions. So I don't want to waste much of our time. We will have a question and answer, and perhaps you can ask to us directly or put it on the chat box. All right. I can see that here. There is one question, Mr. Somea. Maybe I can. Yeah, the first one is from Mr. Girindra.
Okay.
Yeah, it is on the chat box.
Yeah, I can see.
Yeah.
Atu Bugos Winguna.
No, Girindra.
Sorry. Good. Oh, okay. Second one. Okay. All right. Let me read. Okay. I have two questions today. First question: is it possible to combine crowdfund with bond to finance? Oh yes. Why not? But if it depends on the companies. If the company is big enough, then you can use both. Yeah. But remember, the size of crowdfunding is growing, but still lower. I mean, small in compared with what you can fund through bond. So, okay, and the bond finance. Okay, such as building infrastructure, providing a social insurance for poor. Okay, all right. Now this is good point. Yeah. So maybe for big infrastructure, maybe crowdfunding is no use because size is small. Yeah. But if community infrastructure, I'm from fisherman village in Japan. We had only 2,000 people in my village. Yeah, but sometimes without help from the big city, we have to build a small maybe road or bridges, right? Maybe you need maybe only $30,000, something like that. For this reason, yes, crowdfunding is actually may work. You can advertise, hey, our village want crowdfunding. Yeah, and then to all the villagers who are living outside the village, yeah, they are going to perhaps contribute. Second question: there is a huge possibility of fraud and embezzlement in crowdfund projects. Should government or another international party put up regulation to oversee crowdfunding projects? Yes, this is perhaps we need to have a kind of monitoring body, or maybe we need to have a regulation for this one. Yeah, but I agree with him. All right, second one. If you have any, okay. Nice. Second, Fitrania.
Yes.
Yeah. Okay. Nice to meet you. Okay. How your opinion about price Bitcoin? Well, now price bubble. Well, now. Okay. With COVID instance, many stock market have dropped, but not with Bitcoin. How do you think? Okay. Well, I'm not, I'm an economist, but I used to work on the market, but not anymore. Well, I'm not sure Bitcoin is bubble or not. Um, we have one agreement on the bubble. Bubble is mysterious. We don't know. But one thing we know is actually, we know it was bubble after the bubble took place. So beforehand, we don't know. So that's why actually I'm a kind of a small economist, that's I don't know. My answer is I don't know. All right, let me, one of the COVID, okay, okay, all right. So let me, one of the advantages of Bitcoin is that the transfer fee is cheap and its value has increased. Yeah. What do you think will Bitcoin be the next payment? Yes, Bitcoin is also one of the instruments for settlement and clearing, right? And then it's going to be so. It is one instrument for clearing and settlement at this stage. So it's gonna be. I'm not sure it's gonna be a major instrument or not, but it is instrument, and it's gonna be. I can say. How your opinion about okay, we have done it. Okay, is it finished? Okay, no. I have a peer-to-peer lending in mining of Ciproto. Oh, okay. Okay. Everyone can get 300% during the contract period. How tips can get investor for investor to join? Well, that's actually you have to ask the business persons. I'm an economist to analyze. Yeah. So I don't know, but Bitcoin. Well, digital currency is promising, and that's why actually people are investing in maybe Bitcoins. Promising in terms of the instrument for settlement and clearing. So we will have a digital currency soon, but how, we don't know. I don't know. Right. Thank you very much.
All right. Is there anyone else that want to ask to Mr. Somia about something? All right. Mr. Somia, honestly, I have one question. Perhaps
go ahead, please.
Okay. Yeah. We have some instrument, recent financial instruments, such as what you mentioned before, such as crowdfunding. What is the prospect when we talk about solving economics problem such as inequality, poverty? Is that any way to solve this by doing this instrument? Thank you.
Okay. Crowdfunding, one of the function of crowdfunding is actually crowdfunding improved access for SMEs to financial funding. Yeah. And then, big corporation people get lots of high salary, not like myself. And then small corporation, SME people get lower salary, right? So SME get more funding through crowdfunding. That means actually their salary goes up, they go up. And the crowdfunding is not, how can I say, is not effective instrument for big corporations. As I said, because they have access to financial market through bond issuance, bond or equity. So crowdfunding is actually benefit only. I mean, not only, but mostly small and SMEs. And then that means people working for the small SME will benefit. That means actually income inequality from between the guy working in the big corporation and the guy working in the small corporate SME will be, narrowed down. So it's going to be a good for financial inclusion, and then also good for the income equality. That's what I think.
All right. Yeah, thank you very much, Mr. Somea. And all right, one thing again for maybe, is there anyone of you that perhaps have question for us? All right. I think there is no one, Mr. Somea.
Okay, let me make an excuse.
Yes, of course.
Do I look red?
Yes, a little bit red.
Yeah. When I see, this is the problem with the camera, not myself. So I'd like to excuse. I'm not really red in person, but because of this camera, always everyone you also look red when you sit here and use camera. So that's my excuse.
yeah, but well, that's I don't see any problem that, but we get what your point, Mr. Somea. Thank you very much.
Thank you very much. Right.
I hope we can meet at another opportunity. And before we finish our session, I beg your permission, Mr. Somea. We will have a photo session.
Okay, sure.
So dear participant, I hope all of you can put on your camera so that we can take a photo. Yeah. All right. So this photo session will be conducted in 3 fold of Zoom. I will conduct this photo session. The first one in 3, 2, 1. Right. And the second fold in 3, 2, 1. Okay. And the last fold in 3, 2, 1. All right. That's all for today. And again, thank you very much, Mr. Somea, for your kind lecture today. And I see that all of our participants send their best regard to you. And I hope you are always in your good condition and stay healthy in this pandemic. Thank you very much.
Thank you very much. I'll see you guys